Are you like most sales and other professionals who want to grow their wealth faster than what they are currently doing through their company 401k, even with that company match, the stock market, or just plain saving money? Would you sleep better at night if you had the financial freedom to be job optional in just 3 to 5 years through investing in real assets? Maybe you don't want to stop working, but wouldn't it be cool if you could retire a decade earlier than most? And do the traveling you and your family have planned for years while you're still young and can enjoy it? Let's face it, most busy professionals don't have the time or desire to take on more work outside of their W-2 to grow their wealth. On The Wealth Flow, each week we share the stories, the investments, and take a deep dive into the various asset classes that can deliver that accelerated growth to your portfolio passively. That's right, no extra work for you. Instead, we'll put your money to work. Learn what the 95% aren't talking about and join the top 5% of earners today on The Wealth Flow.
All right, welcome to The Wealth Flow. My guest today is Jim Pfeifer. Jim is the maverick behind Left Field Investors, who is rewriting investment rules and blazing a trail in passive investing in syndications. Formerly a financial advisor, Jim has transformed into a cash flow expert. He's breaking free from the standard playbook. His commitment lies in sharing his knowledge with others who are eager to explore alternative ways to grow their wealth. Not only does he provide guidance and advice to the investors, but he also invests right alongside them. Jim is a strong believer in community personal finance, understanding that embarking in large investment deals alone can often be perplexing and risky. It is with this understanding that he founded the Left Field Investor, an organization dedicated to passive investments, thriving on principles of knowledge and sharing, networking, and continuous learning. Within this vibrant community, individuals connect, grow, and make informed financial decisions while benefiting from my dynamic support system. So, Jim, welcome to The Wealth Flow. I'm excited to find out more about Left Field. Yeah. If we could, maybe let's just start with you know, where you grew up and kind of your background before Left Field Investors, and you know what eventually led you to and not only investing in real estate, but just investing. Period.
Yeah, that's a long story, but yeah, I grew up in Anchorage, Alaska, and that's kind of the beginning. But then when I went to college in Ohio and Oregon and kind of bounced around a lot and ended up working for a reinsurance company out of college doing underwriting and marketing. But I was a finance major, so I was always interested in finance. And right out of the gates, when I had a salary, I was begging them to let me put money in the 401k, you know, but you had to wait like 6 or 9 months or something like that. And so I waited, and then I started investing in mutual funds and eventually in stocks a little bit. And I was always really interested in building wealth. And I was confident that the right way to do that was the stock market, mutual funds, and things like that. So I worked in that job for about 11, 12 years. And then I decided I wanted to do what I'd always wanted to do growing up, was to be a teacher. But I didn't do that right out of the gates because teachers don't make enough money. And I liked money and finances. So I became a teacher and taught finance and accounting. Did that for, I think, seven years. And then I became a financial advisor. And that's the time when I really started learning about money, because they start over and teach you from scratch. And at the same time, I had become an accidental landlord because we had we'd built a house because we had another kid and needed more room. We couldn't sell our old house. It was right around 2008 or 9 when the economy was very difficult to sell a house back then. And so as the financial advisor group was reteaching me about money, I was a accidental landlord on the side. And so I was seeing how real estate affected things. And they kept teaching me to do, to go into products and these things. And as they were doing that, I was realizing, wait a second, real estate is really where it's at. And so I did financial advising for a while until at some point I was all in on real estate. And I always prided myself in, buying the same products that I was selling to my clients. And I couldn't do that anymore because I was putting all my money in real estate. And as a financial advisor, I could not sell real estate to my clients. I didn't have license for it. And, that it wasn't a product that my company sold. And so I just kind of fell out with financial advising because I couldn't help my clients do what I knew was better to do, which was real estate. And that's when I became a full-time active real estate investor. And I did that for a few years and realized that I was a terrible asset manager. But I ended up making a lot of money on these active investments because it was the good days of the market, right? Everything went up. You could be a bad asset manager like I was and still make money. And so at some point, then I realized I found what passive investing was. I found out what syndications were. And that was where I was like, you know what? I'm a limited partner. That's what I want to do. And once I figured that out, just kind of off to the races and started really looking into it, investing in passive syndications. And I started out doing it wrong, making all the mistakes, spent a lot of time learning from those mistakes, and started when I was an active investor, I'd started a community, a meetup, and it was pretty successful. And so I thought, well, I'll do the same thing with passive investing, but I'll just make it a little 12-person dinner club in Columbus, Ohio, where I live. We'd meet once a month and just have people just chat about passive investing. And our first meeting was March 18th, 2020. And if you remember back then, that's where the week the world shut down. So we couldn't meet in person. And we went on this new thing, Zoom, and we decided to meet it there. And that's when it took off. I tried to limit it to 12 people. It eventually grew to 20. I spent the first year, we were able to get some really awesome guests to come to our meetings because everyone was sitting around with nothing to do. So we had some high profile guests, and our group kept growing. And I spent 2020 trying to limit it in size. So we only had 50 members at the end of 2020 because it was really hard to get in because I didn't want it to grow big. I thought it was a mastermind. And then once I realized my neighbors, my friends, former financial advising clients, they all wanted to know, what are we doing with this real estate syndications? What's passive investing? I realized that there's a real thirst for this knowledge. And that's when we started Left Field Investors. And now we're, a community of almost 2,000 people who are all interested in the same thing, which is building wealth through real estate syndications. So that's the short story of the long story.
Yeah. Okay. Well, there's definitely a lot there. Couple things, maybe going back to just the beginning there. What is reinsurance? I'm curious about that. You'd mentioned that. I mean, obviously, I'm familiar with insurance, but just didn't know what reinsurance is.
Yeah, it's kind of like a bookie that lays off bets is the easy way to explain it. But an insurance company, let's say they want to insure a restaurant and the restaurant has liability insurance of $1 million. Well, maybe the insurance company doesn't want to take on that full $1 million if there's a loss. So they will go to a reinsurance company and say, hey, we'll take the first $250,000 of this loss if you take any loss bigger than that. And so the reinsurer, those are very infrequent losses. So the reinsurer can do that to a lot of different people and charge a small premium. And then the insurance company doesn't have to pay out the large claim. They just pay out the small claims and the reinsurer takes the large ones. And they do that with liability insurance, property insurance, all types of insurance. The insurance company doesn't hold all the risk. They sell a lot of it off to reinsurers. And so I was an underwriter where I would determine the cost of that risk that we would accept from the insurance companies.
Okay. I was thinking that that was it. Just we had several conversations on this show with some folks and talking insurance and some of the increases in price, and part of that is due to reinsurance prices going up as well. So, okay, just wanted to see if I was on the right track there. And then when you got into real estate, you mentioned kind of becoming an accidental landlord, and that's how a lot of folks get kind of started in real estate for the first time with rental houses. And so from there, what type of real estate did you invest in? You mentioned not being a great asset manager, so just curious as to what your focus was.
I didn't have a focus. I was just doing whatever came up, right? So first, I was an accidental landlord, and I hated it. I did that for 5 years. The guy, I had the best tenant ever, but he would call me on Christmas Eve and say, "Hey, the shower's broken," and I had to go over and fix it. And he made me take my shoes off, right, to get in the house because he was so clean, which is great. But I'm like, this is my house. I take my shoes off and just stuff like that, and I just did not like it. So I went to my realtor after 5 years and the market had improved. And I said, I want to sell this house. And he said, well, hold on a second. You have a tenant in there. They're a good tenant. They were a guy from Japan actually, and his company had secured the lease. So it was just a great situation. He said, how about this? How about you let me manage it for you? And he knew I had paid off the house, which also was a bad move financially. And because, the equity in your house always returns zero. So what he said is, how about this? How about you get a loan out on the house and then I'll sell you 2 more properties. And so what ended up happening is I took one house that was paid off with the equity earning nothing that had one tenant, and I turned that into 3 houses total, all with rents coming in, all with mortgages, all with tenants managed by somebody else. And those properties always did great. And that got me into like, oh my gosh, this real estate thing is amazing. So if I have a single property, that's awesome. How would I make more money? Get a multifamily property, right? Or flip a house. So we did both of those things. First, I flipped a house, and it took about a year, and we made hundreds of dollars. And if you know anything about flipping houses and you make hundreds of dollars, that means you lost big time because you're supposed to make tens of thousands of dollars, and we made hundreds. So that was a bad one. So I said, okay, I'm not a house flipper. So why don't we just buy like a fourplex? And so I went to and I found a real estate agent, said, yeah, I'd like to buy a fourplex. He's like, well, let's look at some other things too. And I ended up buying a 22 unit and then an 8 unit and a 4 unit. So I kind of went backwards. And they were C-class properties. And, I was just looking at cash flow. I'm like, oh my gosh, these are going to cash flow like crazy. They did not cash flow well, they did. They cash flowed negatively. So it was just a disaster from the beginning. But again, they appreciated like crazy when I finally figured out what I was doing and could sell them. We did make some money. And I also got into turnkey properties in Memphis and Indiana and Dayton, Ohio. So I kind of was sampling everything. And it's funny because the ones that, well, they all appreciated, which was nice, but the only ones that ever cash flowed were the original 3 that was sold by the realtor I was using here locally.
Okay. Yeah, that's interesting. When you buy older properties, multifamily, can be single as well. It's amazing how, on paper, at least at first glance, it looks like it's going to cash flow very beautifully. But oftentimes it's repairs, water bills, all kinds of stuff that come in at you that kind of put a drag on the cash flow. Well, and then from there you went into teaching. I'm interested to get into hearing about left field investors because I think that background in teaching finance and also being a financial advisor probably just gives you some really strong backbone to be able to really help guide those conversations that you're having with the members.
Yeah, I realized this eventually, and I think my wife helped me realize this too. I've always been in education. Even when I was in reinsurance, after like the first 3 or 4 years, I took on mentorship roles to new people that we hired because we were always hiring new people out of college college. And that was my favorite thing was mentoring them. The reinsurance part, the marketing, that was fine, but I really enjoyed the education. And that's why I, pivoted and became a teacher. And, when you're teaching usually kids who aren't real interested in learning, right? I was in high school. I didn't want to learn anything. I just wanted to have fun with my friends. So you're kind of forcing the education. And then as a financial advisor, you're educating also people that are a little bit resistant because they know you're educating them to sell them something. And there's a lot of trust issues that you got to get through. And so that was a frustrating type of education as well. And then once I got to, what I'm doing with left field investors, now I'm educating or helping educate really interested, passionate people. And man, that's a really fun type of education. And it reminds me of when I was first in reinsurance, because that was also educating people who were, interested and eager and all of that. So I have a great respect for high school teachers because that is the hardest job you can ever do. And maybe the second hardest is being a financial advisor because man, that's a tough gig. And so I'm happy now to be in a place where I'm really passionate about helping people learn how to build wealth a smarter way, which is to get out of Wall Street and get into real estate.
Yeah. Okay. And tell us a little bit about what, you mentioned that this group kind of started right in at COVID. Originally it was in person, then it went to Zoom, and you've grown exponentially. But tell us a little bit about what the group does and, what kind of investments, you take a look at. and just kind of how it works.
Yeah, we're a community first, and what we do is we provide members education. We provide them a network of other people that are looking for similar type investments, and then we provide deal flow and interaction with operators. So that's the focus, and the focus is on the community. And we have webinars where they're educational webinars. We have webinars where deals are presented from various operators that we're in connection with. We have a lot of networking. We have a meetup coming up in April. We're going to the Best Ever Conference, and we're going to have a full day of education just from left field investors for the Best Ever Conference. We've also had conferences in Columbus where we're kind of located with most of the owners that live here in Columbus. So we do that. There's just a ton of stuff, a lot of education. We have blogs, we have clubs. So, there's meetups in all different parts of the country. There's a North Carolina club, a Seattle club, so that people can meet in person, because people really, really like to get together. Because the thing about community and why I'm so excited and passionate about the community is, if you're going to walk out your front door and chat with your neighbors about finances, what are they going to talk about? They're going to talk about the interest rate on their mortgage, their IRA, their 529, all this stuff. And then you're going to be the guy who says, well, what about real estate syndications? And then you're going to turn around and they're all going to be gone. They're going to be in the backyard talking about the weirdo who's talking about, crime syndicates. And because they just don't understand. So there's not really a place for you to learn or educate yourself. If you want to learn about stocks, turn on the TV. Half the commercials are trying to educate you. So that's what the power of this community is. It's a place to go. And that's why it grew so fast. And we're still adding members all the time, because people are really interested in having a place where you can go and learn in a comfortable way. And one of the most proudest things we are about our community is the culture. And it's not, the culture that the founders built. It's the culture that the community created. We have a forum where you can go and, you meet a new operator and you go to our forum and you type in their name and then say, hey, has anybody ever heard of XYZ? And you'll get, 5 or 6 people. Yeah, I invested with them. They're awesome. Or yeah, I invested with them, but they don't communicate timely or whatever. So there's just so much information out there. And it is really, really difficult to be a passive investor. Because if I can take a minute to talk about how you find an operator, right? Because you want to invest with somebody. So when I first started out, I went to a seminar, and it was a big deal for me because I spent my own money, right? I was used to working for corporate America where, I just put everything on my Amex and, expense it. I spent my own money to get on a plane, bought a hotel room, paid for a conference, and went to this conference. And it was, there were a bunch of operators there. And when I was there, I realized I want to invest in these syndications. And so I just assumed, well, they're putting on a conference, so all these operators must be just awesome, because otherwise, why would they be there, right? That's my first mistake. You can just show up, right?
Yeah.
And so I had an old IRA that had some money in it, and I converted to self-directed so I could invest. And I started walking around to operators saying, hey, here's my money, right? That's how I vetted them. They were at the conference. And I would just say, hey, can I invest with you? Terrible, terrible way to do it. A couple of those investments turned out horribly, as you would expect. Some are fine. Some went great. It was like picking stocks by throwing them at a dartboard, right? Not super effective. So then I thought there's got to be a better way. And so I started listening to podcasts, reading books. And I thought, well, if they're on a podcast, they must know what they're doing, right? They must just be amazing, because why would you have them on a podcast? And then I learned, okay, so I started selecting operators through podcasts. And I would call them up after the podcast and say, hey, I heard you on the podcast. Talk to me about your operation. So at least I would interview them and get some more information. Much better way of finding operators than my original, but also a bad way to find operators, because they might just be a great operator, or a great marketer. They might be great at talking on a podcast. That doesn't make them a great operator. Now, they might be both, but it doesn't tell you anything. So again, that I had some better success there, but then I started talking to the people in my community, people that I know, like, and trust. And now I don't invest with a new operator unless they're introduced to me by somebody I know, like, and trust, who's already invested with them. Now, it doesn't mean the investment went full cycle and paid out. It just means they invested with them for a year, right? So they can tell me, do you get reports in a timely fashion? If you send them an email or call them on the phone, are they going to respond in a timely fashion? Have you gotten distributions that have been promised or they said they would send or not? And so it just gives you, I still do all the same due diligence. I still talk to them and find out all I can about them, but I'm already 100 steps ahead because somebody that I know, like, and trust has kind of vouched for 'em. And it's not perfect. It doesn't mean every deal works out. Lots of deals don't. That's the nature of investing. But I tell you what, I have a lot more quality investments because I rely on my community. And that's why I'm so passionate about, in being in a community. And I think if you're going to be a passive investor in real estate syndications, the number one thing you can do for your success is join a community. It does not have to be left field investors. I think we have a great community, but you got to be in one or five or 10. I don't care, but you got to be in one because this is not a one player game. It's you need help.
Yeah, for sure. And so do people bring these potential guests to come in and speak? You mentioned, people you know, like, and trust, and I think that's great. I mean, that kind of already separates some of the potential sponsors from the pack. But when you introduce somebody or allow them to come speak to your group or your community, what are the kind of the criteria? Somebody brought them, somebody that's in the community, or you may have found them through somebody else that you introduced them to the community with?
We're also a do-it-yourself community, right? So we're not recommending people. We this is where you mentioned community personal finance in the opening. This is a term we're trying to kind of just let people know what it is. Community personal finance, right? And so if I can take a little tangent and explain that, I think it will help you understand the community a little bit better. So there's traditional finance. We talked about this, the stock market, Wall Street, right? It is super easy because everybody does it. It's not scary because you see it all the time. You know what a stock is. You understand what a mutual fund is. When you go and work in your first job, they tell you, here, put money in a mutual fund through this 401k. So it's all familiar. It's not scary. Everybody does it, right? But the returns aren't that great. And the tax treatment is terrible, right? You don't know. I don't know personally, or anybody that I've heard of that has gotten rich or created, generational wealth by investing in the stock market. You're either buying companies or you're in real estate or something like that. You're not sitting at your desk trading stocks. It's not how you build wealth. So that's traditional, right? Then you go to alternatives. And I don't know why they call them alternatives, because it's the place you live, the place you go to work, the place you go to the mall. It's all these, it's real estate, right?
Yeah.
So alternatives, it's scary because you don't know where it is. You don't know what it is. You have to send a wire to someone you never met. Probably most people have never sent a wire in their life unless they're buying a house. So now you got to do this wire, and it's scary. And a lot of the investments are hidden because they can't advertise them. It's the SEC regulations, right? So now you're investing in these things you don't understand. No one else is doing it, and you can't even find the investment. So it's scary. It's difficult, all of that. But the returns are better, and the tax treatment is amazing. So you want to do it, but it's super scary. So enter community personal finance. And that's what we do at Left Field Investors. Community personal finance is where you take the community and you marry that with alternative investing, and you have people that are helping you. So we're trying to turn community into a verb. So your question was, how do we find deals? How do we find operators, and who brings them in? The community does. If we see an operator or meet a new operator, we community that operator, meaning the community vets the operator together. Somebody knows them, they talk about them, share it with somebody else. Somebody else says, hey, have you asked them this? These are the other questions. Same with the deal. When we're looking at a deal, you community the deal. Someone says, hey, I'm so-and-so operator has a new deal out, and they post it on our forum, and people start talking about, did you ask them this? What about this? What about the economic vacancy? All this stuff that comes up. So we community it. So back to your question, sorry for the tangent.
No, it's good.
But when somebody brings a new operator, they might be discussing it in the forum. Now, we also have webinars that we put on. So operators come to us. We have some that are partners that we know very well, and those we allow to do deal webinars on our site, where an operator can go and do a webinar for a community, and then maybe they give us better terms because we invest as a group, or we know them well. And then other new operators, they might come and say, hey, can we do a webinar, either an educational webinar or a deal webinar. And those, we don't vet them because the community does that. We try to remain unbiased, but we do kind of check on them to make sure that, they're on the up and up. We don't just let anybody present to our community, but we also don't, as long as the reviews we do, as long as they seem like they're on the up and up, then we allow them to present to the community, and then the community does the due diligence for everybody as a whole. So it's kind of it's a team sport, definitely.
Okay. And with what you're investing in the folks that you have on, is it multifamily syndicators? Or is there a variety of different commercial real estate syndications? What are you primarily seeing, or maybe what is a mix of what you're seeing out there?
Yeah, it starts with multifamily, right? Most people enter this space with multifamily because it's familiar. Everybody's lived somewhere, right? You either at some point probably lived in an apartment, or you knew somebody that did, or you've seen one, right? So that's easy to understand. That's the bulk of it, and that's where people start. But then we believe in diversification, and there's all kinds of different types of diversification, right? You want to diversify by asset class, by operator, by market, by the length of the investment, by the debt in the investment. So there's all kinds, but one of the key ones is asset class. So we certainly are exposed to a lot of different asset classes, and I couldn't name them all, but there's triple net leases, there's industrial, there's self-storage, ATMs are super popular. Some of the other interesting ones, there's car washes, laundromats, there's just almost anything you can think of, medical offices, dental offices, it can all be syndicated. And it's just a matter of understanding the asset class. And so we do a lot of, that's why we do a lot of educational webinars, because if you know how to evaluate a multifamily, well, then you could probably evaluate maybe a mobile home park, and then you could probably do self-storage. But when you're talking about car washes, that's a whole different beast. So that takes a different analysis. So there's just a bunch of different asset classes. And I have the common disease of wanting to chase that shiny object. So I'm always looking for a new asset class. But I try to practice. I learned this from I have a podcast, and one of my guests, MC Laubscher, the cash flow ninja. He coined, I don't know if he coined this term or stole it from somebody, because I stole it from him. JOMO. It's the opposite of FOMO, right? FOMO is fear of missing out. JOMO is the joy of missing out. And so I'm trying to practice that. When I see a new asset class, I'll investigate it, learn about it, but I'm not necessarily going to jump in and invest in it, because I'm gonna do some JOMO. So that's what I try to practice, because the shiny object syndrome, it causes you to make bad decisions sometimes.
For sure it does. I need to start practicing that JOMO myself. So
yeah, exactly.
That's great. And so tell me a little bit about the education piece of it. So do you guys talk about and really show people maybe how to analyze a multifamily deal, and kind of what makes a car wash from a business standpoint different than that, and go into those kind of details where folks are actually understanding how to do it?
We do. And there's a number of ways that we do that. So as we said, we put on webinars where, if you're talking about car washes, we will have a car wash operator come on and do what we call lunch and learn. There is no pitching of deals. It's just strictly education. Here's what it looks like. Here's some of the metrics that you should be looking at for if you're going to analyze the investment. Here's the returns you might expect. Here's the operations, all of it. So that's one way. The other way, or there's a lot of different ways, but we have blogs. So we might write a blog on how to, here's a car wash. What should you be looking for? Then we also host, networking sessions, everything in Left Field Investors. We're not baseball fans, but we've latched onto baseball. So we call it a mound visit. And that's just a networking session where we'll jump on a call with a bunch of people and just talk. And someone will say, hey, have you ever invested in car washes? And then you'll have 5 different people saying, hey, here's what I look at. Here's what I look at. So there's a lot of collaboration with that. And then again, I mentioned we've had meetups, and when we have meetups, it's all, there's 2 things we do at the meetups really is networking, because people really want to network. And we do education. And the networking is important because you can meet other LPs, other limited partner investors, and really learn from them and share ideas. And then you also we bring operators to these meetings, and we make sure that every operator gets to meet every single person at these meetups, because ever since the pandemic, you do so much virtually, and it's great. Really, it really helps. It saves money. You're talking on Zoom instead of flying all over the place. But it still is not a substitute for meeting someone, shaking their hand, and kind of feeling the vibe and getting to know the person. And I can tell you, it makes it so much easier to send a wire to someone for $50 or $100,000 if you've shaken their hand, had a beverage with them, shared a meal. And so that, the networking part is really, really important to our community.
Yeah, that I agree. It's kind of interesting. Like even with my W-2, we finally have started traveling a little bit more. We started traveling, I guess, a couple of years ago, but started getting together as a group. And there's people that literally I've seen, even just a couple of weeks ago, folks I hadn't seen other than on Zoom. And I'm like, man, that guy's actually a lot taller than what I expected, or
Yeah.
whatever it may be. It's like, but it is cool. And as you mentioned, be able to share a beverage and just have a conversation. It makes you have the ability to learn that person, engage that person a little bit better.
Yeah, it's amazing the difference it makes. And you mentioned that funny story. One of our founders, well, a few of our founders had never met each other, right? We had all come together on Zoom. There were a couple that were out of towners, and so for our first meetup that we had our first meetup was 2022. So we'd worked together for 2 years, and they hadn't met each other. And then one of our founders showed up, and he was at the meetup, and I looked at him, and I was like, I wasn't sure that I recognized him because something was missing. And it took me a while to figure out he wasn't wearing the headphones like you have. And I don't know if you have video on this, but it's the over the ear headphones.
Yeah.
And he didn't have those on. So I was like, I hardly recognized him because I'd only ever seen him with those on. And so it is amazing the difference when you finally get to meet someone, you shake their hand, you really get a better sense of the person. I think Zoom meetings and all of that, there's a place for it, and it's fantastic. It's really changed everything, but there will never be a substitute for just sharing a space with someone to really get a sense of them. And investing, it's important because it's not all just numbers. It's not all you read the pro forma and you're like, okay, yes, this is a good investment. We have somebody managing that investment. When you're a passive investor, you lose all control. I mean, all of it, right? All your control is up front. You have to vet the sponsor. You have to analyze the deal. You have to figure all that out. Then you have to wire your money. And as soon as you hit send on that money, you are done. You don't have any control. And it's a long-term investment that might take 5-10 years to play out. So getting a sense of the person you're investing with, and you can't beat that. And that's an in-person thing when you can do it. Now, I don't always meet them in person before I invest, but it really gives me confidence to do that.
Yeah, for sure. And how often does the group get together? I know not as a group in person necessarily, but kind of what's the cadence for taking a look at different deals? How often does the group meet on Zoom?
We used to have monthly meetings where we would have a meeting and either have a speaker or something like that. And then we started doing lunch and learn webinars during the day. And we did deal webinars and some other webinars. And I think last year we might have done 1 or 2 webinars a week, and they were all live webinars. But what we noticed last year is, the first years, 2020, 21, and even 2022, most people seemed to be working from home. So it was no problem to kind of transition and spend their lunchtime at a webinar with us. 2023, we noticed the YouTube views of the recordings went up while the attendance went down at the live webinars. We were getting, 250 people watching the YouTube video and 10 people coming to the live webinars. And so we switched. Now we don't do any live webinars. It is all recorded. And same thing with our monthly meetings. We used to do them in the evening because that was easier for people. But now people are so busy again that the live meetings are a lot more difficult. So most of our live events are either these mound visits that I talked about, which are very informal, just networking, and then our annual meetups.
Okay. And so where all are folks meeting up on these mound visits, just from a geographic standpoint and maybe geographically as well? How do you have members pretty well everywhere throughout the U.S. or what is kind of the makeup there?
Yeah, so the mound visits are virtual. Those are still on. Though
Okay.
they're on Zoom now. They originally were just phone. Now they're Zoom. But we also, as I said, we have in towns across, like we have I think Arizona, Seattle, the Carolinas, Jersey. We have some of these places where our members, they start a club in our online club, and then they will meet monthly or quarterly in person. And those are typically in cities that, we do those in Columbus, but they also do them in other cities, and those are hosted by our members, and just a way of kind of getting together. We also have clubs based on, different interest groups. We have a young person's club, right? Because someone that's 25, 30 that's just getting into this is not typical. A typical member is older. We also have a women's club where when at all of our events, they meet in person, but they also meet quarterly on a Zoom call, and they have their own club where it's just for women only. Because let's face it, unfortunately, this industry is dominated by men. If you go to a conference, there's a lot more men, and men like to tell people what's what, I think. And so when you get into a group and you allow the women to get together or the young people to get together, it's not dominated by the typical person. So we try to create space for everybody to comfortably have these conversations and educate each other.
And how about are most of the members of the community accredited investors? I would assume, but
Well,
maybe not.
that's funny that you ask that, because we estimate that probably 25% are non-accredited. And I think operators and other communities really miss the boat on this one, because most of them focus on accredited investors. But the most passionate and engaged people in our community, a lot of them are non-accredited. And that might seem strange, but when you think about it, why are they so engaged? Because it's really hard for them to find investments, because there's a limited number of investments and operators that will offer something to them. One of our founders is non-accredited. And so we really try to focus on the non-accredited as well, and not forget about them, because you can make $250,000 a year and be married and you're not accredited. That
Right.
doesn't mean you don't have $50,000 a year to invest in a deal. We also use a company called TribeVest that allows us to invest in groups. So on some of the deals that our community invests in, you can get into the deal for $10,000,
Yeah.
right? So you could be non-accredited, making $100,000, and still invest in real estate. And so that's why I think we try really hard not to forget about the non-accredited investor, because they're important, and they are sometimes they're the backbone of our community, because they are so engaged, because they're trying to look around for investments, and then when they find an operator they like, they share it loud and wide to everybody, like, hey, this company takes non-accrediteds, and they all kind of flock to it. And the accredited investors enjoy it too, because they found a good operator. Then they can invest in non-accredited deals. So yeah, we're a mix, but I'd guess about 25% non-accredited.
Okay. And maybe talk a little bit more about what you described with TribeVest, where you have the ability, in a typical syndication, and obviously they all vary, right? But you can invest 50,000, 100,000. I mean, there's different limits. Sometimes it's 75,000, whatever it may be. And there's sometimes it's less than 50. But it's not. Most of the ones I've seen are around that $50,000 buy-in
Yeah.
to do it. And so to be able to invest a smaller amount, obviously it makes it so that you can diversify a lot more, right? You can stay, even if you had said, I do have 50K to invest, but I'd like to put 10 here, 10 here, 10 there. There's at least an ability to do that. But tell us a little bit about how that works with with TribeVest.
Yeah, you nailed it. I mean, if you have 50 grand to invest in a year and you don't have TribeVest, you're probably putting all that money on one horse, right? So the only way you can diversify is over 5 years, where you can get into 5 deals, right?
Hmm.
And that is dangerous and uncomfortable. But with TribeVest, as you said, now you have 50 grand, you can get into 5 deals if you want. And the way they do it, TribeVest is just a group investing platform. They don't provide investments, they don't provide advice. All they do is make it really, really easy to get a group together of people that know each other or people that don't know each other, and they will set up an LLC for you. They will administer it. They will do the taxes. They will get all the members together. There's a website where you have a portal so you can sign in and you can see all the members. There's messaging on there. You can store the documents. They'll open up a bank account for you and you can wire money right out of that bank account. So it just really makes it easy. And they have a couple of different products. One's an open tribe and one's a pro tribe. And we don't need to get into those details, but they only offer those through Left Field Investors. So we're super fortunate. But what it allows you to do is exactly what you said. You can get into more deals. And it's not just if you only have 50,000, right? I'm in 11 different tribes, I think, and there's different tribes for different purposes. Some are people that don't have a whole bunch of money, but they want to learn how to do this. So we did a 10-person tribe, and I kind of trained them and said, here's how we do stuff. And I helped them find the first investment. And then somebody else works on the second one, and everyone kind of works together. You create all these mini masterminds. Or we were talking about car washes earlier, right? Well, if I'm not familiar with car washes and the minimum's $100,000, do I want to jump in and invest in a car wash? I'm a little bit leery of that, but this is a great way to chase that shiny object. Right now, I can get in and say, you know what? I'm going to find 9 other buddies who are interested in car washes. Let's all put 10 grand in. Now we got 100 grand. We can test it out, see if it works. And if it does, then I can go in on my own or do another one with the tribe. So there's a lot of different ways you can do it to use TribeVest, but it's just another tool that we use at Left Field Investors to optimize our investing.
Okay. Yeah, no, that's fantastic. Great information for sure. How about when it comes to educating, do you talk at all or have educational pieces on investing in a self-directed IRA and, kind of what the process is and how to do that? Maybe if you want to talk a little bit about that, but also about, your own personal investments, if that's how you're investing in most stuff, or you doing a variety of both investing directly?
I think we definitely talk about it, and we do education on how to do self-directed IRAs or self-directed 401ks. Those are a little bit better. I am not a financial advisor or tax accountant, but there are reasons you can avoid some of the accidental taxes that you might pay, the UBIT and UDFI, I think, in the if you do it through a self-directed 401k. But me personally, and what we talk about is if you don't have cash available outside of your self-directed IRA, then yes, I would invest in a real estate syndication with my self-directed. If I do have cash, I'm always going to start with the cash I have, because the tax advantages of investing in real estate are tremendous. If you do it right, you probably won't have to pay taxes on any of your real estate investments. So there's no reason to put it in a tax advantaged vehicle because you lose those tax advantages, right? So what I do is the only thing I do out of my self-directed IRA is private lending and debt funds, things that don't have tax advantages. So I put those in my tax advantaged account. And when I invest in syndications, I'm using only after tax money. Now, as I said, there's a lot of people in our community who do invest through their self-directed IRAs and 401ks. And the reason is because maybe they don't have the capital right now in their after-tax accounts. So they use their self-directed, because I would much rather be in a self-directed, in a syndication through my self-directed account than putting that self-directed account in the stock market, right? Because to me, there's speculation and there's investing. And I think there's some of that should be in your portfolio, right? Some of each. Now for me, 90%, I want to be investing, 5-10% maybe in speculation. And just as another tangent here, I guess, speculation to me is where you put money into something and you're just banking on the appreciation, right? There's no current benefit. You're not getting paid anything to hold that investment. You're just holding it and hoping at some point you can sell it to somebody else for more at a later date. That is speculation. Right. And that is also exactly what you do in the stock market. Unless you're in a dividend stock, there's no current benefit. You're buying that stock and you're hoping at some point you can sell it for more money to somebody else. That's it. That's your only exit strategy. Where investing, to me, that's what you do in real estate, right? You invest in something, you have a current benefit in the form of cash flow, right? You're taking money from operations. The thing's profitable, it spits off extra cash, and it goes to the investor. That's not speculation. Yes, you get appreciation on the back end, but that's the bonus. You are investing for the cash flow. And so to me, that's why I kind of lost track of the 401k thing here. But the point is that, I want to do investing in my tax on my after-tax account, and I do speculation, and I do debt things in my tax-advantaged accounts.
Okay. No, that makes a lot of sense. One question I have, one of the recommended topics that you had was the lazy 1031 tax strategy. Tell me a little bit about that. It's the first time I've heard that term. I've heard, not 1031, but the lazy part.
Yeah, well, the 1031, as you know, is where when you sell a property, like you own a property and you want to sell it, but you don't want to pay taxes on it. So what you need to do is there's all kinds of regulations at the time, and it's very complicated. But the gist of it is, if you buy a similar property that has a more debt and is a bigger property, you can defer the tax and not have to pay it, right? So, and you can do that until you die, and then it ups the basis and your heirs never pay tax. So that's a great way to never pay tax. But it's super complicated, and it requires you always to have a bigger property and a bigger mortgage, which means more risk. And maybe you don't want that. So what I did when I was exiting all of my active real estate, as I said, we made pretty good money on that. So I went to my accountant and I said, I'm going to have a tax bill. What can we do? And he said, well, Jim, I have two things to say to you. One, sometimes when you make a bunch of money, you got to pay a bunch of tax. And I said, okay, I don't like option one. What's option two? He said,
Yeah.
Well, you could do a lazy 1031. I said, okay, I'm intrigued. What's that? He said, well, as long as you do it in the same calendar year, right? That's the only time requirement. Or if you have a bunch of loss already built up. Basically, when you sell an asset, you have a gain. But when you buy a real asset, if it's real estate, you get depreciation, right? And now there's this nice thing called bonus depreciation where they accelerate. It used to be 100%, might go back to 100%, but they accelerate a bunch of the depreciation all into year one. So what that does is if you sell, what I did was I sold my active assets, then I went and bought real estate syndications, and I targeted some that I knew would have large bonus depreciation amounts in year one. And so those losses that I got allocated to that went against the capital gain I had from selling my active real estate. And you can do it with syndications too. So then all I have to do is buy a bunch of real estate with the gains and some of the principal of the assets that I sold, and the new depreciation offsets the gains. And so if I keep doing that, it's called the kind of the golden hamster wheel, right? So then when that syndication goes full cycle and sells and has another big gain, I take that money and I buy a new syndication. And the depreciation from that syndication offsets the gain I just got. And so you can basically do that until you die, and then you never pay the tax. So it's called the lazy 1031 because it's much easier. And when you first invest in a syndication, let's just say you don't have any other investments in your entire portfolio, and you have $100,000 and you put it into a real estate syndication, right? And let's say they're going to pay you $10,000 a month or a year. It's a 10% return. And let's just say, for ease of math, that you get 50% depreciation is when you buy it, right? So in year one, you're going to show a $50,000 loss. And let's say that they have, maybe they do pay you the $10,000. So now you have a $10,000 gain and a $50,000 loss. You have $40,000 of loss, and that carries over. So for the first 5 years of that investment, you don't pay any tax. And so as long as you keep layering in and you're going to keep investing in real estate syndications, every time you buy one, you get a chunk of depreciation, and it offsets. And so you can go through your entire investing career and never pay the tax because you're deferring the whole time. And there's other things to think about. There's depreciation recapture when you sell, but a lot of that can be eliminated because not all the depreciation is the same. Some goes on a 27.5-year schedule. Some is a 1 year or 5 year. So you don't recapture all the amount that you took. So it's just lazy 1031 is just a strategy to defer your taxes, and it's easy because it's natural. Because as soon as you start investing in syndications, you build up the loss before you build up the gains. The loss always comes first in the syndication.
Yeah, no, that's great. I hadn't heard the term, but I've done the process. So
Yes,
I've done a 1031 as well, where I couldn't find another property in time, and ended up not being able to do that with those funds. So I could see how there's a lot more flexibility, I think, in that lazy 1031 exchange. How about maybe, Jim, this has been great, first of all, and I really appreciate you being on the Wealth Flow. Maybe if you could tell folks anything else that you want to let everybody know about Left Field Investors, and then maybe how people could find out more about you.
Yeah. So if you're interested in finding out about us, you can go to leftfieldinvestors.com, or you can send me an email, jim@leftfieldinvestors.com. Love to learn about you and help you if you're interested. And our community, like I said, we're focused on education, we're focused on networking and interacting with operators a lot of times through deal webinars. So that's the best way to kind of describe the community and the best way to connect with us.
Fantastic. How about I've got two more questions for you if you have just another minute. One would just be any advice that you would give somebody who's maybe just starting out in their investment journey.
Yeah, I am going to sound like a broken record. I realize this, but it's join a community. It really doesn't have to be Left Field Investors. We'd love to have you if you're interested. But you got to find a community that fits your personality, the culture of that community. And there's some communities out there that are the suit and tie kind, where you go to one of their meetings and you got to be wearing a tie. And there's communities like Left Field Investors. You come to one of ours wearing a tie, and you're not going to leave with that tie. And it's just a different culture. And both are fine. I don't care which one you join both. But the point is, you want to really find your people and find a place where it's comfortable for you to learn, to share, to grow with others, because that is the number one thing that will cement your success. It's a tough industry. You're going to lose money, but you're going to make a whole lot more, and you will make a whole lot more if you do it together rather than doing it alone.
All right. Yeah, I think that's tremendous advice and couldn't agree more. How about book recommendation? Maybe it doesn't have to necessarily be investment or real estate related, but it certainly can be just something that's been impactful for you.
Yeah, this is a little bit self-serving. It's not my book, but I don't know if you have video here, but Avoiding Rookie Errors is a Left Field Investor by Steve Sue. He is one of the founders of Left Field Investors, and it is 20 lessons learned from 40 years of passive investing in private syndications. It's a small book. It is, again, I'm biased. It is one of the best books I've read because Steve Sue has been doing this for 14 years, and he spells out his 20 biggest mistakes. We have all made mistakes, but the whole point of a community is to learn from someone else's mistakes so you don't make them. Right. Yeah. So you can skip Steve's 20 mistakes and you won't make those mistakes. And so I've read this a number of times because it's easy read, and it just tells you, hey, here's some things not to do. And it's just a huge help. And so I love this book.
Give us the title just one more time. Avoiding Rookie
Errors as a Left Field Investor. You can go to leftfieldinvestors.com/books, and it's right there on the website. It's also on Amazon.
Fantastic. All right, Jim, this has been great. I sure appreciate you spending a little bit of time with me this afternoon, and I think we'll call it a show.
Awesome. Thanks, Keith. Thanks for having me on. It was a pleasure.
Yeah.
Being that you're still here, I trust you found value in this episode. I personally wish I would have known these guests and strategies when I started my wealth creation journey. Go to wealthflow.capital to subscribe to our newsletter. And as a free gift, we will send you our quarterly market report and the top 10 things to look for in an investment opportunity. Take a minute to give our show a rating and review. Help us reach 1 million professionals by subscribing and sharing this episode with someone you know who could also find value in it.